Hello and welcome to IGTV's Trading the Markets. Today's special guest is Eric Strand, founder and portfolio manager at AuAg Funds. Now, gold is a really exciting space at the moment. Price is still holding firm above that $2,000 mark on those hopes of a Fed rate cut soon. Well, Eric, thank you so much for joining us. I guess the first question is, are traders getting too ahead of themselves?
Well, really nice to be here. And the first answer is no. I mean, the participation is really low from the traders. So there's a lot of room to go now. And what is important is that we have established the gold over 2000 for a longer time. It has been going up and down around 2000, but now we get the feeling that we are over. And I think the target is 2100, and that's when it really starts to fly. So now it's a good time, I think, to position yourself. And we also see good inflows in our ETF for the gold miners. So it's just the beginning, I would say.
So what happens if we break that 2,100 level?
Well, it gets really, really free from all technical issues. And I think that's when more and more people will start to participate. And we get the rotation of flows into the gold and gold mining space. And of course, all this happens when the Fed really starts to pivot, as they already started with their talks a little bit. The market's really pricing in it coming. So the dollar will probably be softer at that time, and that will be a tailwind for gold, and especially the gold miners, I would say.
Listen, Eric, we've been looking at the technicals here at IG as well, and if it goes past that 2,100 level, then perhaps 2,400 is the next level. Do you have any sort of time frame as to when we might get there?
Well, we thought for 2023 that we see gold up 20% in dollars. So we're a little bit wrong on that still. It's around 12%, so not far off. And that's maybe because we thought the Fed would pivot earlier, that the system would get in more trouble. But we see that the US have supported the system with a lot of deficits in their budget, like 6-7% the deficit on the budget. So money is still coming into the system. It has survived, but now we think the Fed really have to lower rates rather sooner than later. Mm-hmm. And so it looks really, really good for gold. And as you said, after 2,100, we see 2,400. So if we were not 20% this year, if we stay at the 12% as of now, I think we will get the 20% next year. So next year looks really, really strong for gold and commodities. And I think also we have seen big players like Goldman Sachs thinking commodities will be a good place 2024. That will make more money coming in, not just from gold investors, but from other investors into the commodity space, which is not that big as the bond and equity spaces. So I think a rotation of capital will put the pressure on the price up. I think still the central banks will continue. I mean, they've done record buying in 2022, 2023. So I can't see really any headwinds. It looks really, really strong.
Should investors look to gold miners rather than spot gold itself in terms of getting exposure?
I think if you're looking for a protection in your portfolio, I think gold, the commodity, is the right thing. If you're looking for returns at this point, it's the gold miners for sure. And I would say especially for European investors, because this leverage the miners have on the gold price, it happens before the FX effect. Because if we have a softer dollar, maybe it will lose 10% versus the pound or euro. And if gold goes up 20% in dollars, you will only have 10% net return. But with the miners, if you have a leverage of 2 and the gold price going up 20% in dollars, that would make 40%. And then you lose maybe 10% on the FX, on the pound and euro versus the dollar. And then you still have 30% as an example. And the leverage for European investors suddenly becomes 3-1 instead of 2-1. And this is a very interesting moment to invest in the miners.
Now, speaking of miners, why equal weighted miners? Why would they be better than just looking at their market cap?
Yes, we constructed our ETF with the ticker ESCO as equal weighted because when you do an ETF on a sector that is not that big, you get a concentration in the largest 2, 3 companies. It's a very high concentration. And in a secular bull market for gold and gold miners, they are not the top performers, the largest mega caps. So you get a better or stronger beta to the market with a equal weighted ETF.
Now, the other key metal that we're looking at the space as well is spot silver, around trading at about $24 an ounce at the moment. It's also had a lift, but I guess this is perhaps more to do with energy transition. We know that the energy transition play will continue in 2024, 2025, but many in the market have said it will continue at a slower pace. Will this mean a slower sort of trajectory for silver, or do you see other environmental factors that will cause the price of silver to also go up?
Yeah, there are a lot of reasons for silver to outperform gold in the coming years. And of course, it's the industrial use. We also see in solar panels, the new generations, you actually have gone from lowering the percentage of silver to raise it to have more silver, because now it's more about the effect. So, and the industrial demand is really, really high for silver, and there is no reserves, and the price has been too low for producers to really get going on silver. On one hand, on the second hand, if we have a secular bull market for precious metals, then the ratio between gold and silver always goes down, and sometimes it goes down to normally 30-1. It's around 80-1 now, and that's a big journey. If we would one day have gold at 2,400, we said before, or 3,000, we would have a silver price at 80 or 100, and that would be a massive return. If you would have like 40-50% on gold, you may have 200-300% in silver. So silver is a really very, very interesting investment, but it's very volatile. So you have to stay strong, keep your positions, so you're not thrown off because it's very volatile.
And finally, Eric, which is going to offset the other? On the one hand, we've got some ESG screening, increasing in many of the big banks, many of the brokers, and this is seen as something that will affect miners, obviously. But on the other hand, there's also 2 wars that are taking place at the same time. We've got this energy transition and energy security in play still. And many in the market say, well, the status quo will remain, that energy and energy transition will continue to be important. How do you see this playing out? How do you square that circle, and how will it play out in gold and silver prices?
Well, I think what is important is that all the precious metals are necessary and enabling the green transition. So we really need the metals, and we need to mine them as good as possible. It has never been mined as good as now, and it will become better in the coming years. So that is very important, that we need the metals. And in our ETF with the ticker ESCO, we have the 25 best miners for ESG. And I think that's important because these companies will get more institutional money invested. So these stocks will probably perform better in the future. And it's important for us with our ETF to avoid maybe some, I don't know, I shouldn't say it's Chinese companies, but for example, maybe they don't have such a good ESG work with the workforce and so on. And when you have a market-weighted ETF, you get all these companies or liquid-weighted. So we avoid that in our. So I think it will be both good for returns, but also good for the fund having this ESG screening. And I think we would say the first ETF that does ESG screening within the sector, not making a global avoiding tobacco or weapons, but using ESG screening within the sector. And I start to see that we see more ETFs thinking like that. So using it more in an active, smart way.
Right. Thank you very much, Eric Strand there, founder and portfolio manager at AuAg Funds, talking to IGTV. And do tune in for more analysis on @IGCom or @Angeline Ong on Twitter. This is IGTV.